what's going to happen, right? What moves are we going to see? I got foiled by the SHY paying a dividend. Didn't realize I had a dividend. I was like, we're going to see sell-off in bonds. We'll see.
Ah, so
Expect the
I,
unexpected.
I threw this out just as a couple of things. It's not just a matter of the rate decision that's coming out in 7 minutes. And I say is whether we have cuts, not just cut today, but cuts,
Mhm.
guidance in the future, what they tell us about inflation, because everything we see shows inflation is running a little bit hot.
Yeah.
Employment, which is what I think the real concern is. I think the bigger concern is employment, and they're not telling us the full story. And then whether they back that with any indications of economic growth. At least that's the way I see it. I don't know if there's something that you would add to this or take away from this. And
Uh,
we're going to get this in the presser, but press conference.
the,
But it's kind of interesting to me.
it's really kind of hard to use traditional weapons to try to fight the Fed in their statement, because the fact of the matter is they're lowering rates at the same time they're reducing the size of their balance sheet. They raise rates as they're expanding their balance sheet. I mean, it's like what Warsh said. He's like, there's no policy here. And so if we're trying to use the past and trying to, make any sort of rational conclusions, they're not doing rational policy. Not that they're ever rational, but they're much, much less rational right now. So again, where are we going with this? Nobody really knows.
Well, and I thought that was interesting. Is I mean, every other big meeting, the plans are cutting rates. The plans are they're cutting rates. The plans are raising rates. The plans are leaving it alone. And I like you, I'm always watching the news cycle around the financial markets. And it was interesting because sites like CNN and Bloomberg are saying that the waters are cloudy, that they are having a difficult time reading this. Now, again, we are 5 minutes away. A couple of things that I like to watch for, and I don't know if for those of you that are new or joining us for the first time, one of my favorites, as Brandon knows, I don't use the CME's Fed Watch tool as often, but they're usually pretty close. And I
Mhm.
use the ZQ. I like to watch for the ZQ, and the ZQ is the bond futures. So the bond futures are always trying to price in expectations as far as what the market thinks is going to happen. And so
Yeah.
I'm going to throw this up here. And I like this better because to me, this is money where your mouth is. And they're putting money behind it. So you can see that over the last couple of days, we've held in this 95.52 to 95.52.3. So pretty flat for the last 3 days. And the way you do this, you take 100 to subtract off the current price, 95.5225. And that's going to give you what the Fed futures are pricing in. So that leaves us with 4.4725. That's a lot of numbers. 4.4725, if I did my math right. What is the current rate? Well, we're somewhere between 4.5 and 4.75. So if we're between 4.5 and 4.75, let's call that 4.625. We subtract off the 4.4725, and we should be able to get a number that will let us calculate probabilities. That's a 4, by the way, which leaves us with, here, fine, I'll get my eraser. See if we can do this before we go. Which leaves us with what? 0.15-ish,
Yeah.
0.1525. Now, if you take that 0.1525 and divide it by 0.25, because we're expecting a quarter point difference, that's going to tell you that we have almost exactly a 60% probability being priced in here. And yet the CME says, because that's 60% of the pricing in, CME says that we are at 98% probability. Does this hint that we might get a surprise?
Yeah. I mean, do you really think they're going to go there? I mean, it's been so telegraphed. Now all of a sudden, do we care about inflation? Um, I have a hard time believing we're going to go not have a rate cut today, but I definitely think the next year's rate cuts are jeopardized. I
Mhm.
mean, inflation is really heating up right now. I mean, it's not going away. Um, but then we just find out that I mean, again, we have the mirage of job growth this year, and all of a sudden we say, well, it's not, it's gone, right?
Well, let's not even say mirage. Let's say flat out blatant lie.
Yeah, flat out blatant lie, right? So we
Yeah,
talked. Someone kind of pushed back. We talked about it a couple weeks ago. I'm like, yeah, but it is a reality. I mean, they did walk back some. Now it's basically walking back everything. they know what the issue is, right? And as far as economically, and again, they're trying to do two things at once. They're going two separate directions: reduce the size of their balance sheet and cut rates. But the rate cuts right now are going to be in jeopardy, especially going forward, just because inflation's picking back up again.
Right.
And they know what the president is, right? I mean, Trump just won the electoral college, so he's going to be instituted. And does Powell want his job? Does that pressure him to want to cut rates and more? I don't know, maybe, but
he's already said he's going to go to
Trump's,
war over that one,
right.
and he's not going to let him. He's not going to go quietly. So does he not go quietly, or does he kowtow?
Yeah. So guys, if you want to keep your position, do you accommodate? I mean, Trump wants lower. Every president wants lower rates, right? Everyone wants accommodation. It's the path of least resistance. We're 2 minutes away, Blake.
Yeah. So let me show you what else I've been looking at. This is the euro versus the US dollar. If we're really talking about a rate cut and we're talking about the impact over this is short term, we can certainly look at long term and talk about the fact that the euro has lost all of this to the US dollar. That's a comparative decline of the euro to the US dollar, or in other words, the US dollar has gained because the US economy has less inflation and higher rates, which creates higher demand for the dollar. So if we watch this, we can see we've kind of gone into a holding pattern all the way back since November 21st.
Mm-hmm.
If I take this into an intraday, and this is all kind of predicting what we might expect, these lower highs, lower lows tell me that we may have been pricing in a rate cut and more in the future, but now we've unwound the future. And we're at this little midline, the 50%. If you follow anything I do in monkey bars or what we call time price opportunity charts, that's fair price. So we've priced it out. We're right where we're supposed to be as far as the euro versus the US dollar today. Mm-hmm. But if we're going to see lower guidance in the future, then that might be it for the euro. And this might be the beginning of the next leg down in the euro US dollar chart. In other words, the dollar is going to gain if we're not going to see rate cuts. If we see more rate cut guidance, this is going to go up. The dollar is going to weaken. So here we are 30 seconds out. What do you want to look at? Broad market? What do you want to watch?
Currency. Dollar, gold.
All right.
Bonds.
Oops. Get back there quick.
I know I'm looking on. I got hashtag FOMC. What are we doing?
Boom, boom, boom. 2, 1. Bing, 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 bing. And boom.
Yeah.
Dollar wins.
So Blake, let's break that down. Dollar stronger against the euro. Right? So therefore, what would cause dollar strength in terms of Fed policy?
No more cuts.
No more cuts, right?
Raising rates, obviously, but we're not going to raise rates right after we cut it. That's generally not a good plan, not a good strategy. So as we're looking at this,
they cut rates by a quarter.
Quarter point as expected. But the market had priced in future rate cuts. And remember, do you remember when we were talking about rate cuts up to 8 rate cuts by December today? Yeah. You're supposed to have 8 rate cuts. What did we end up getting? We got 4. Yeah. More than what I thought they should have done. But this is dollar dominance. This is a huge dollar play.
Because I mean, we know where the Eurozone is, right? They're in recession territory plus. We know they're going to cut rates. Their interest rates are lower than our interest rates. And suddenly we're not cutting to get in line with them. At least that's the expectation. So now all of a sudden the dollar's surging. Now that's relative terms. Let's take a look at gold and see what's happening in real terms. Is gold selling off? Probably so, I'd guess.
Now I've got this on a 5-minute chart, just so when we look at that candle and you see a large candle, it's not that it's this massive destruction end of the markets kind of situation. It is the last 5 minutes. So this big candle and a recovery, it does look big, but it's just a 5-minute candle. So don't panic.
Yeah. So not as big of a move. I mean, so despite despite the fact the Fed's not cutting, we're seeing now we're seeing a big move.
There we go. I was gonna say, don't speak too soon.
I know too soon. We're not done yet. I mean, normally when you get these kinds of things, when you get these data releases, 30 minutes is a good time to let the market digest and kind of tick the highs and lows. Tony has his opening range breakouts. You have your own version of opening range breakout, Blake.
It's all based off the previous distribution off the
Yeah.
TPO or monkey bar chart. So
Yeah. So in essence, we're trying to build this kind of range. In the next 30 minutes may help us develop that range. And then all of a sudden Powell's going to take the stage and start talking. And then we might see how we break out from there. But yeah, the initial is dollar strong. It means Fed policy is going to be less accommodative. That means more hawkish. That means higher rates are going to stay a little bit longer, at least the expectation based on whatever came in the report today.
yeah, and then what I would also say, the comments are that we're still pricing in 2 rate cuts in 2025. Let this settle out for just a minute, and then we'll go look at the ZQ again. We'll see if the market has adjusted to that expectation and whether we're seeing that set up again. Now, what I would show you is if the dollar is getting stronger, and since we just looked at this, this is gold quoted in US dollars. So one thing that, as Brandon and I are both kind of currency and econ type of guys, we look at the big pictures. Yeah, fiends. I actually used to have, that used to be my Twitter handle, Forex Fiend.
Oh, was it? Nice.
Yeah.
Great minds think alike.
This move down here, if this is gold falling in US dollars, you got to remember that doesn't tell you whether gold is falling across the board. So let me show you whether the market is afraid of inflation or not. And one of my favorite things to look at is here on Kitco. Now, Kitco.com is I don't know who they are. They're live gold prices. This is showing you gold's move in all of these currencies. Gold is down 0.06 versus the Australian dollar today, 0.29 against the Canadian dollar. Now, this move here is going to be a lot more dramatic for the US dollar, but 0.56, 0.62. This is not updated every second, but it's down behind it a little bit. But all of these, except for the Brazilian real, the only one that's gained is the Brazilian real. So everything else is really, the currencies are stronger than gold. Gold is losing across the board. So I think this move in the US dollar is saying we're more concerned about other things than we are inflation. We are not inflation hedging at this point, at least not with gold. So gold is now down, and we've dropped approximately $11, and that's against the US dollar, but it's down across the board. Unless you're in Brazil, gold is losing today.
Yeah. And surprisingly, the S&P is holding up so far. We have faded from the high a fair bit. We're towards the low of the session. And I just turned up my volume to the maximum possible. So hopefully that fixed it. But anyway, yeah, this is going to, so if we're not going to be accommodated, we kind of set the tone for the world. If we're not going to expand our money supply and we're letting us hang up here, and all of a sudden we start to hit the fan again, what's going to happen is we're going to see implosion, and that may strengthen currencies relative to gold as the money supply contracts. And so that's my thought process on why gold is weaker here. We're just saying, look, I mean,
and we're still going. We're not done.
And we're still going, right?
Yeah.
And this may, if the dollar continues to strengthen, the S&P is also priced in dollars. It is going to start to drag, and once we start to break key levels, we may see that crescendo in terms of like selling pressure in the S&P. But we are historically hedged right now, so if the S&P is holding back, it's because hey, skew is the second highest print ever as of yesterday. We've just never really been this hedged, this prepared for a sell-off. This week's volatility was pricing in like $60+ earlier today, and we only got 2.5 days left. So we're pricing a lot of volatility, and so it's going to take a lot, but we're starting to see it right now.
Yeah. A lot of bearish pressure. Let me throw the ES on there since we're talking about the ES. And when we look at volatility, your volatility hedge or volatility indicator skew, it's based off of the S&P, at least the VIX, right? Because you're using the 3-month VIX and the 6-month. Sorry, these charts are really slow. I'm sure we're just getting tons of data pulling through here.
So we're, if I look at the ES right now,
there we go. Again, 5-minute candles, don't panic.
Change event, but
yeah. There you go, down 22 points.
Yeah.
Now,
so on Monday, you saw there was a pretty sizable trade in the inputs on the SPY, for example. The week before, we saw big time activity in the VIX markets for Jan 22nd. And so I talked about last week a VIX vol spread. Just buying the call volatility, buying the 20, selling the 30. And so hopefully, that may kick in, but the VIX may be slow to move initially because we've been so hedged.
If you
But
want to
if
share
we
your
start
chart,
to
I
move
can.
outside the bounds, it could really explode.
If you have a chart you want to share, I can pass
Well,
you
if you
control that.
just bring up VIX.
Okay.
Um, so the idea is that, look, I mean, there was buying at the 20 calls a little over a week ago. And so VIX right now is at about 16. It's kind of muted because SKU's been so high. There's so many hedges that have been placed. This is not an unexpected downside move. It's only a matter of the pace. So if the pace really picks up and we combine that with a bigger, more selling pressure, this is what may cause the VIX to really move big and may push it above 20. And that VIX vol spread may really pay off. So you buy the 20 call, we sold the 30 for Jan 22nd based on that activity. And so, but right now, as I talked about last week, expect the VIX to be slow to move until we start to really get outside the comfort zone. And then that's where you start to buy the puts directionally and sell stock. So we'll see. So, yeah. So some talk about Russell. What's Russell doing? What's Russell up to?
Yeah, like I said, these
Yeah.
charts are
Down
running a
about
little
a half
slow.
percent.
Come on. Oh
So
my gosh, I'm having a hard time typing there.
it's okay. So Russell futures are down about the same as the S&P right now. So, I hate it when that happens, right? Just like it wants to lag right when you need it the most. Um,
There we go. Well, I think it's just because I'm sure their servers are being
yeah.
maxed and taxed.
Healthcare
So,
yesterday was showing strength in particularly like, pharmaceutical biotech and
well, before you
it
go
was
through
holding a out sell off too.
the Russell, even though it looks big on the intraday, it's only down 0.5%
Yeah,
for the
it's not a
day.
lot.
And there's a little support level back here at about 2340. That would also be that monkey bar or the time price opportunity chart. It's just kind of showing you this is where it could stabilize and hold. So it's not too crazy. It's just a pullback. We're just
Yeah.
breathing out the
Yeah.
rhythm
So,
of the market.
and that's why the VIX isn't moving a lot. It's controlled, right? I mean, the percentages aren't big. Real estate's down nicely, 1.5%. Gold's down 1%. But again, real estate does not make up a large percentage of the market cap of the S&P 500. It's banks, which are only down 0.5%. You have technology, communications, and right now those are kind of leading out. Financials, communications, and technology, apart from healthcare, those are the three best performing sectors, all down. But we have not hit the panic button yet.
Well, and so here's real estate. And one thing is, wouldn't you have expected a rate cut to be something would be more of a stimulus for real estate? The rate cuts would be driving the real estate higher. Now, XLRE is including existing properties
Mhm.
and REITs and things like that. You take something like ITB, home builders, which is one of the top ETFs, and you can see we're still selling off through here. So where is the positive drive that would be a lower rate cut? If we go into ZN, there's the bonds. You were talking about bonds earlier. Instead of the bond, ZQ, we're looking at the bond prices, and bond prices are down. And if bond prices are down, which way are bond yields going? Up.
Yeah.
So bond prices are now approaching a 6-month low or year low. We're dropping down despite the rate cut. So people get all excited about the rate cut from the Fed because it's going to drive money, and they say, oh, that means it's going to be good for housing. It doesn't mean that mortgage rates came down. So the fact that bond prices are falling, the short term can be cut 25 basis points, and yet the long term, this is the 10-year treasury note,
Mm-hmm.
is up and approaching its high,
Yeah.
4.45%. So which means mortgage rates are 6.45, and a rate cut did nothing to help the mortgages, nothing to drive business into home builders.
And
This is
there's
not
two
a good sign.
things. There's two things that affect, borrowing costs. Number one is the risk-free rate. We're looking at treasuries, but it's
Mhm.
also the perception of risk. And obviously it's obscured a bit with mortgage bonds because you have that kind of backstop where a lot of it's selling to Fannie and Freddie. Um, but again, there is that, that element of risk that priced in. People say, well, wasn't it priced in? Well, if we're looking at the market right now, not fully. There was, and I missed who voted against it, but there was some that voted against rate cuts. So we're looking at that, and I'm not sure. I should have looked if there's a dot plot, but
Yeah,
yeah,
so pull that
again,
up too.
we're not seeing a significant amount of volatility. This is not like some major sell-off. It just looks fast because it's like a Saint Bernard through the doggy door, right? I'm like, we have a very short time window, 1 minute, and it's trying to push through, and it looks big. But in the bigger picture, if you open the door, it could comfortably go through it. So as we expand over time, thus that 30-minute kind of opening range, if you want 30 minutes, you go short if you want. But once we kind of expand that range out to, let's say, 30 minutes, and now we'll see how impactful it is. So is it moving at the same rate, or are we going to slow down? And now all of a sudden, instead of the St. Bernard going through the doggy door as the visual that Jeff Foxworthy provided back in the day, no, it's actually we're opening the door for the St. Bernard to come through, and it's just the St. Bernard, right? If that makes sense. I'm trying to use your analogies, Blake. There's some sort of like not that's not your analogy, it's Jeff Foxworthy's, but
Yes, you like using analogy and
but
being
something.
analogous.
And what's on the t-shirt today?
Oh, so for those of you that don't attend the daily for the last 5 days, and I'm going all the way to Christmas, I wear a Christmas specific shirt, and I thought this one was good for the Fed because it says "Hello, darkness, my old friend," and I've got Jack Skellington dressed as the Grinch and the Grinch dressed as Jack Skellington.
Oh, there we go.
So, so the anti-heroes of the Christmas season.
How's that
And
working for Craven right now? Sony Pictures.
that's not quite
11
the same
million on its
thing. debut. Yeah, my
Villains are done.
my son was excited about it. I don't know.
I like the character, but I'm
Yeah, I
like,
like the
but
character. I just don't
clearly
know enough.
execution.
And plus, it's just an '80s character. It's hard to capture the feel of an '80s character when we were
Yeah.
so it's hard to wear a little fur over your shoulders with a half vest. All right. So notice where we're at. This is a kind of interesting in the pullback. Like Brandon was saying, watch for that first half hour. Really, this 15 minutes works pretty good too here too.
Yeah. Just pick your time frame, right?
Yeah, pick your time frame where you're looking at, and you'll notice we've fallen back to the 0% line. This is the weekly levels. So we've dropped back to the 0%. That's just a distribution. So if we say this is what the distribution was last week, this is what we can expect this week. And I just want you to see, even with the Fed, distributions pricing matters. And so when you see this move for this entire week, you can see it's gone up, back, forth. It wants to find that fair price. It rejected the 100 or the 0% at the top of the distribution. It's now toying with the bottom one, but it's struggling here, even after a massive 0.6% sell-off. Nothing too exciting here, and we're dealing with this part now. I've also done something on big events, on econ, on earnings, and what you usually can do is, and this will make Don happy, you can throw a fib on this. And I do mean a fib, not my numbers. Mine are not fibs, but you can throw a fib on this. And if you anchor the pre-market, pre-announcement, pre-earnings, pre-econ high, in this case, or low if it's going up, and you anchor that from here to here, and every time you make a new low, you keep anchoring it. But if you go past that 38%, there's about an 80% chance that you're going to go back up to the 50 and about a 60% chance that you're going to go to the 61 on a correction. And all it is whatever momentum, you have to wait till it's done. And right now, it's still continuing. So we don't really have an endpoint to this. We're just still drifting lower.
Yeah, and
So
on
watch for
that's
one-third.
something where you're looking for very extreme near-term readings. I mean, if you're like an RSI, maybe at like a 7 or a 10, it's buried the needle down on the bottom. So you can see that right there on your tricks. Obviously, we're
tricks
very, very low, but the
tricks
idea
is
is that you're
a
kind of
triple smooth
fading
momentum
that
indicator.
support.
Just so it's not a defined oscillator.
Yeah, right.
For those of you, I know you know that.
Oh, that's right.
I know you're aware, but I'm saying for those of you that are not familiar with the tricks, it's basically a triple smooth MACD. And so if you're using an oscillator like a stochastics, I use a 733 just because I'm using it for divergences and for things that are overbought, oversold. But you can certainly, RSI would probably give you a better indication of how extreme this is and where the end is. But I would look at that and say, yeah, we've kind of buried the needle on all of this, and we're down here. And currently we have a stochastics of 3. So we are still drifting lower. So
There was a question that we got an email in and was asking about, okay, so volatility goes up. How do you play the volatility coming back down? And that's actually an easier story. You sell premium, right? Now
Hmm.
we're clearly not there yet. The VIX is still just barely getting started here, but the anticipation is that if the VIX really pushes up, it gives you an opportunity to sell premium. Higher volatility means you can sell further away for the same amount of premium, if not more, especially if skew comes down for verticals. So this is where you get excited. You anticipated the correction. Now we're potentially getting it, and you're going to capitalize on the VIX going up. And then once the VIX goes up, then we capitalize on the VIX going down by selling premium on a product like ES, MES, SPY. It goes back to, in like an inflection point spread, for example.
So are you trading generally when you're doing something, even if it's an event like this, are you generally trading the VIX options or options on the VIX
So
or
so
VX or
last so last
VXN? What do
week
you
we
like to do?
walked through a VIX spread, buying the 20 for January 22nd, buying the 20 call, selling the 30. The way that the volatility is shaped in the VIX is that the volatility rises on the calls as you go out of the money. So it's very, very amenable to buying call verticals rather. And you could potentially sell a put spread as well. But again, we just bought the call spread. It's like 52 cents on a $10 wide spread.
Wow.
But man, if we push through 30, I mean that pays off pretty dang big. It's like it
You
would
said
have
those the
gone to,
Januaries.
yeah, it was Jan 22. So the
Okay.
next week,
Oh,
2030s.
next week.
Um, so that spread right now, it's not up, it's up 20% right now. It's not a lot, but
Well, it's not you might say
it's going to pick
20%
up
is
if
not
we
a
get above
lot.
20.
Yeah, I was
So
going to say as soon as you get above 20, that accelerates. And for 50 cents for potentially a 950 reward on
yeah.
this, what a great trade. And this is certainly not fading it. So I think you've got the backing for this long-term trade, even though it's maybe the catalyst could have been today.
Yeah. So Dimitri asked a good question is, what's the point of bidding on Monday just to sell off today? But here's the thing, what was bid on Monday? So it's for this. So I did it, my Monday's video, I focused on the only stocks that mattered. It's the Mag 7. So what was bid on Monday was the Mag 7. From my standpoint, I look at that and say, why are they buying Mag 7 stocks? Because they have no clue, right? They
Mhm.
figure if the market goes up, if at least I buy this stuff, it's going to go up with it. But if the market goes down, obviously there's no solace to that strategy. And we saw it fade yesterday. And obviously we're still kind of holding things up, but that's obviously fading today a little bit. But again, this is not a big move yet, right? We're only down 0.6% on the S&P. That's not a big move.
Yeah,
Just wait
look.
till Powell comes up. Will Powell put his foot in his mouth? It's happens a
Yes.
lot.
Oh, wait. I mean, absolutely he will.
But so I mean, it's again, never underestimate Powell to take a 0.6% pullback to a 2 to 3% pullback.
That's right. And the guidance, again, I brought up the things that we need to be watching for. We got our one cut. Do
Yeah.
we plan on future cuts? Do we price that in? What's the guidance? What does he talk about? Inflation, employment, and growth. If we go back to that ZQ, if I can find my chart again, if we go back to the ZQ, what we're going to be looking for, I'm going to be looking for is to say, are we showing that that pricing in has changed? So let's go to the ZQ, but this time, instead of going here, because we've already, we're already past, this is going to go
Yeah.
into exactly the right price and stop. So we need to go into this and look at the future prices. And so the comment earlier is we're pricing in 2 for next year, and we could go to the CME and look at that as well. But what you're going to do is say, what's our anticipation for January? What's our anticipation for February, March, April? And so this number, the higher it goes, the narrower or smaller the rates get. So if it was at 100, it would be 0% rates. So we're pricing this in. If you look out to March, April, May, notice these numbers stop moving higher.
Mm-hmm.
They're not, I mean, they're drifting higher just because you have time, and that gives your probabilities wider to work with. But even if we go out to June at a 95.865 compared to now and compared to our 100% number, that leaves you with 4.135.
Yeah. That's
So
that's
by
not a
June,
three
what are we?
percent rate, folks. That's not a 3.75 or a 3.5. That's over 4%.
So we're talking 4.135, and based off today, we're at theoretically somewhere between 4.25 and 4.5. And I still hate Bernanke for that, by the way. It's all Bernanke's fault. We've gone decades and decades and decades
I
with an
know.
actual rate.
I know.
And
It would
then
be so much
Bernanke went
easier to
somewhere
calculate
between.
probabilities.
Yeah, you have to guess. And so I always just simply say, to make it easy, we go halfway between 4.25 and 4.45 or 4.5, and we get 4.375. So by June, this is today's rate now, since we're somewhere in between.
Mhm.
So by June, we're talking about a difference of 0.24. One rate cut by June. Now we can go out to December and see what that is, but watch for these numbers. If these numbers are declining, which is what your net change is showing you, then the lower these numbers get, the higher the rates are.
Mhm.
So today, yes, we're pricing in one more cut by June, 100% probability, at least by June, maybe earlier. I would say probably April is where you're pricing it in there. But the fact that these numbers are going down means we're unwinding future rate cuts.
Yeah.
We're unwinding that expectation. So if we look out here to by the end of next year, a year from now, we've unwound that second rate cut by 0.115. That means we've decreased that second rate cut by 50% probability.
Yeah.
That's a major decline in probabilities based off today. That's just one day. That's a big
Yeah.
move for that pricing.
Now, Lost the Wood mentioned, I think I'm starting to miss Greenspan, but who initiated this inanity? I mean, if you go back to Greenspan's essays back in the 60s and stuff, this guy changed 180 degrees. He instituted the Fed put. He put us in this track that we're currently on of raining money. But again, so I was very, very disappointed, Greenspan. But also someone asked about why mortgage rates aren't coming down. I got to scroll down to see who it was, but think about it. This is the overnight lending rate between banks. A mortgage is 30 years. So when we're talking
Well,
about
mortgage is 30 years, but they use 7 and 10 years to
right,
hedge.
right. So 30 years, but we turn it over faster than that, 5, 7 years. So the idea is we kind of typically go with the benchmark 10-year rate. But again, 10-year treasuries versus 13-week T-bills or overnight lending rate. A 10-year treasury is not impacted as much by the Fed policy as it is the outlook for inflation. So, and right now inflation is elevated. Even the 10-year expected inflation rate, I think, is back over 3% now. So, we're kind of in a mixed up position, and risk premiums as well will add to it, pad it a little bit more too.
And I just threw this treasury yield. This is directly from the treasury, and this will show you their actual bond rates for all these different time frames. So we can see, we can take the 1 month, which is really the Fed funds rate. The discount rate's roughly the 1 month. They used to do the 30-day Fed funds rate. And so this is what we're really talking about as far as the treasuries are being offered. And this is annualized, so you don't get 4% for 1 month, but it's annualized through there. And as you look at this, you can see 4.46, down, 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 up. So we are in a weird flat to slightly inverted as we're getting paid less yields through here. And that's the other reason why I don't think you're seeing them move in lockstep, is because we're still trying to deal with an inverted yield curve.
Yeah.
Our 2 years is 4.22, our 20 years is 4.68. So that's normalized right through there, which was the bigger issue before, or 2 years versus 10 years, still upward. So it's normalized, but we still have some inversion. So I'm going to call it flat. Because it's not, it's kind of like this, right? And so the cutting of the short term is impacting here, but it doesn't guarantee that it's going to impact those 7 and 10 years, which is what your mortgage rates are based on.
And so I was looking through different posts here. Price inflation. So the idea is the Fed's expected range of inflation is actually moving up a little bit. And so again, that's really contributing. Did we know that before? No, we didn't. So again, there's little things that are coming out, and the reality is, and it's inane that we have to parse through the words of the Fed, or like there's a little shift in this or that. That is so important and so preeminent. But again, right now everyone's looking next year. We're talking about potential cuts in spending. We're talking about, okay, what's going to happen from a regulatory perspective. what's going to happen from an employment perspective, and then you add on top of this the Fed. And again, we're kind of in a position where people may want to take profits early. And that's been my story for the last couple of weeks as we're seeing these volatility measures explode. Do you want to end the year positive? Because what we've seen over the last year, when the S&P dropped 8%, the NASDAQ was down 13%. The average NASDAQ stock was down 46%. So the problem is market catches a cold, you get pneumonia and die, right? So we got to be careful. So taking profits here, kind of shifting the, rethinking how you're allocating right now is a big thing. And right now we were hedging a lot of it from a market level perspective, but what happens if we actually start to reallocate and see real selling? That's what we're not sure about, but that may be coming. We'll see.
Well, and I think you almost said it right. When you're doing the little, no, we really are shuffling the chairs on the, aren't we shuffling the chairs on the Titanic here?
Pulling the gears.
Yeah. Well, I was actually more talking about we're shuffling
The deck chairs on the Titanic.
deck chairs on this Titanic. When you see unemployment's worse than what we thought, or employment is worse than what we thought, we know that we have $1.3 trillion of debt. We know that the interest rates aren't coming down as far as long-term lending, which means the housing isn't going to bump up, which means that credit card rates are not coming down unless they pass new laws. This is all on the shoulders of the consumer. And like you said, longest streak ever that we've had accumulation distribution or the advanced decline line negative,
right?
16 days in a row. Yeah, while the market's going up. We haven't had this happen in decades. And so when the market's going up and this is going down, that's a warning too. And notice we're just kind of oscillated back and forth on that target. This for me looks like we're going to continue.
Yeah. And that's the thing that happened on Monday. Market was higher. VIX was higher, but it was being led by a handful of stocks, Mag 7. But you look at the internals, we had more declining issues than advancing issues. So if you look at a ratio of advancing versus declining, it was 0.66. So we had a significant number of stocks that were declining while the market was rising, and the VIX was reflecting that because the VIX was higher that day too. So it's NVIDIA. There was a lot of call rolling yesterday in NVIDIA.
Yeah. So you had NVIDIA still up 3% today, and you have some AMD and Texas Instruments and other things like this. What I was going to show you is if you go into your market watch, visualize, and go to index watch. When we talk about advanced decline issues, what you're going to do is you're going to pick which watch list you're going to do. And I like to use the S&P 100 because I really don't need to see all 500. I just want to see the major ones here. And so there's always going to be 101, by the way, 100 optionable. And you can see we have about twice as many in declining as advancing. And I always double check, say volume, issues, and capital. So as I look at this, as number of issues lower, we're 4 times, meaning 20% are up, 80% are down, 4 times they're in decline, 2 times the volume. But then when we get to capital, we're almost 3 times the capital. There's 3 times the amount of money rushing for the door on this move. And so yes, NVIDIA can be up 5%, great. But we have 3 times the capital leaving. Advanced and declining issues is helpful, but not nearly as helpful, in my opinion, as paying attention to the actual money behind it.
And if we look at, so I like to do a ratio of declining issues and advancing issues. $sign DECN plus $sign ADVN if you use a pairs ratio. But right now, the number of stocks, the ratio of declining to advancing issues is only around 3. So we have 3 more declining issues, 3 times more declining issues than advancing issues. Yeah, then you got to bring up a pairs ratio study. So DECN, ADVN.
I dropped off the N. That was my fault.
But there's only 3 times more declining issues than advancing issues. So again, the market, we're only seeing it right now. We're only down 0.7%. We're not seeing a very high degree of stocks down. You start to see 9, 10 times more declining issues than advancing issues on the New York Stock Exchange. Now we're talking potentially a potential bottom in the near term. But anyway, so if you go pairs ratio, and then I hate the fact they use mathematical operators for this. But no, then just put the composite symbol. So say okay on that and okay. And then, yeah, just put the $ ADV in. Sorry, I'll $ DEC in.
Gosh, dollar sign. See, now it won't clear it off. Hang on. $ DECN
Plus
plus
$
$ADVN.
So it'll give you two things. The composite symbol, it looks like you didn't have
Will
the
it
pairs
though?
ratio. Yeah. You have to have the pair, maybe the pairs ratio didn't get added, but anyway, the point being is that you'll see
It's down here at the bottom. There's your
oh
three.
yeah. So you're on a minute chart, 5 minute chart. You gotta go daily to really appreciate it, I guess. But
Will I
oh yeah, it's on the
appreciate it
bottom
though?
here. So
Yeah, it's on the bottom
right
here.
now
2.9.
we're only about 3 times more stocks selling than it going down versus going up. A spike like we got, for example, back in August, you're north of like 9 or 10. That's a significant selling day. And so that's a heavy distribution day. That's that kitchen sink. Everyone's selling. Now you might look to buy when you're up there like a 9 and 10 range, like we were in August 5th.
So I'm not watching Powell. I'm watching the text.
What do we got?
He's saying that inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer goal. So what is he saying? We haven't done what we said we had accomplished.
Yeah.
They've already done the victory lap on mission accomplished. Let's all go home as far as the interest rates while keeping inflation there. But he just said it's eased significantly, but remains somewhat elevated related to our 2% longer run goal. And he's talking about core PCE being at 2.8%. So long-term inflation expectations appear to be anchored as reflected in surveys as household businesses. So remember, it was transitory when he said that inflation was transitory. Now he's saying it remains well anchored. That's a change.
Yeah.
Inflation is here to stay, my friends. You can just suffer along, and we haven't hit our target. It remains somewhat elevated, is well anchored and reflected in surveys of households, businesses, and forecasters. And the most important aspect of those being households and businesses. So this is a change. I would say this is one of the other things you want to watch for is change in the view. He's talking about the dual mandate to promote maximum employment and stable prices. And we see risk to achieving our employment inflation goal as being roughly in balance. And we are attentive to the risk on both sides of our mandate. And that's what I've been saying for multiple weeks.
Right? We have no clue which direction it's going to go.
Yeah. He's saying we're risk for both directions.
So I'm looking at Twitter just to see updates with hashtag FOMC. This guy's like Jay Powell and Gary Gensler should go to Gitmo. I'm sure Don would be that with Gary Gensler.
Yeah,
Don no likey Gary Gensler.
The way I see it, this is what you and I've talked about it multiple Fridays, is that the fact that they were even willing to cut rates tells me they were a lot more concerned about employment than they were inflation. That the risk is really that employment is struggling, which tells me that businesses are struggling and consumers are beginning to struggle, and it's going to get worse. He said, we know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraints too slowly, better too little, could unduly weaken economic activity and employment. So I think he's tipping his hand, but not very far, but it's really saying that we are truly worried about employment.
Yeah.
Because he just said inflation's hot, it's hitting the homes, and and all the stuff, but then he said, and it's the employment data.
Yeah. And right now the Fed expects unemployment to be at 4.3% versus 4.2% today. The revised PCE forecast from 2.1% last month to 2.5%. I mean, that's a meaningful change. So now all of a sudden we're close to our policy objective, 2% inflation. Now we're at 2.5% for 2025 PCE.
Wow. He just said that we're going to be at 3.9 Fed funds rate at the end of next year and 3.4 at the end of 2026. So he just told us his targets on the Fed fund rates is all the way down to 3.4. Yeah, he's telling us that we're going to cut another almost a full point within 2 years. So two cuts next year and 2 cuts in 2026. That sounds like a disaster to me, and the market doesn't like it. You can see it's continuing. We just actually broke that key level that I was talking about. 60-90, the monkey bar level, the distribution level was just superseded, and we were pushing lower. And we just confirmed, like I said right here, I said this looks like we have more downside. And sure enough, we've dropped down to 60.71. We bounced back up. This is not good news. We are not going to price in a point rate cut over 2 years based off what they said when we're clearly afraid of employment.
Yeah. I believe it said Fed's Powell statement, somewhat higher median projections on funds rate in next years are consistent with higher projected inflation. So clearly, I mean, inflation is causing them to pull back on policy. Rosario's yelling gold. What's gold doing now,
Rosario's yelling
Mike?
gold, but gold is selling off, right?
Gold selling. Because
Originally.
again, here's the thing is that I asked this question yesterday. I'm like, what is inflation? Is inflation good for the market? And I said, there's probably a question you want to ask first before you answer that. And I said, it's about a matter of what kind of inflation we're talking about. If it's just rising prices because of other factors that are outside the Fed's control, that's not necessarily good for stocks as it eats into profits. If this is about monetary expansion, we're expanding the supply of dollars, which this is antithetical to that. If we're not going to ease as much as expected, that is good for stocks. So if we're just seeing the Fed has to hold back on loosening monetary policy, and at the same time we're seeing inflation in terms of costs going up, that kind of hits you on both sides, and that's not where gold does well, right? Gold just doesn't do well just because prices are going up. It does well because the money supply is expanding.
Well, and I'd add to that, it goes up if the money supply is expanding, or in addition to, if the market is trying to hedge because they don't think that the action from the Fed or the economy is going to manage it. If we can't let the free market, the free hand manage it, or the Fed manage it, then I need to manage it by hedging with gold. And we're saying we're not hedging with gold here.
So I think that's why gold outperforms the S&P during corrections, but I'm not always sure it necessarily provides a positive return. It just provides a better return.
Yeah, and some that buy and hold gold, keep in mind there's a cost of carry in paper, and there's a risk of theft or loss in physical gold if you're carrying it at your house or someplace it is.
Yeah.
And if you store it at the bank, that's also a cost of carry.
Yeah. Beef prices are through the roof. I mean, continue to rise. Our herds are very, so again, these are the policy decisions we've made over the last few years to reduce our productive capacity. And that is going to affect us going forward and keeping prices of stuff high, absent any sort of real policy decision by the Federal Reserve. And that was kind of where we were a little over a year ago, where Powell was saying, well, what can I do about supply constraints? So that's why, again, we've got to start to produce more. We got to be more productive and not do it at the consequence of massive deficits. We got to be able to allow people to finance themselves and produce. The government has to reduce expenditures, but in the near term, that can be painful, right? That transition can make it hard for the economy.
Well, and we just, by the way, I'm still listening to you and reading the chat. One of the questions was, why'd you cut? And they said because today was a closer call, and we decided it was because we thought it was the best decision to foster achievement of both of our goals. So there's another evidence, not only that one person dissented, but that was closer call as they tried to decide what to do. And the risk appears to have diminished, but labor market is looser than pre-pandemic and clearly still cooling further. And so I don't know how many times he's going to say what I keep saying is that they showed that they were more concerned about employment. Yeah. As far as gold and the positions there, and as far as the sell-off in the market, I guess the question I would ask for you, Brandon, on the big picture, is this the move where we see bonds bounce, or is this where we need to be looking at safety? And do you really think that Bitcoin is the place to be with the Bitcoin movement off inflation? So I'm asking multiple questions there. I don't know if you want to try to answer them all as I continue to read
the bond market. So right now, look, if the Fed keeps policy tighter, that may lower the outlook for economic growth in the future and the outlook for inflation. So what I would be looking for right now is saying, look, we could see a rally in the bond market if we really start to see that outlook deteriorate. So it's more of, can I guess which one it's going to be? No, but I can wait to see what happens to the bond market But what I do know is that if the S&P really starts to sell off hard here, it's because that outlook is diminishing, and in which case the safety play of bonds may start to kick in. And remember, if it's more deflationary or disinflationary pressures, you want to increase the quality and go longer the duration, which puts you in something like TLT.
Hmm.
But again, that would be more of the safety play. Fed's not going to cut. Things are going to get a lot worse. We're lowering our growth outlook, and maybe the inflation outlook doesn't change a lot, but bonds may rally again with the broader market sell off as we're more willing to buy bonds at market versus buy stocks. As far as Bitcoin goes, though, I mean, again, how much speculation is in Bitcoin? Can we
All of it.
quantify it? No. Right? BTC is paper Bitcoin. It's not even Bitcoin. It's
Right.
paper, just like GC is. And so
Oops.
if we start to see a curbing of these animal spirits and we start to see maybe margins get raised on Bitcoin futures, we start to see people take some losses and those weekends start to sell, Bitcoin may act like your meme stock here. Because again, gold's going to go down because of the dollar strength. Bitcoin is going to go down because of the dollar strength, and XY, the idea of people just selling because they've treated it like it's an asset and like it's an investment and not an asset that just holds its value. Because again, we want to have it both ways, Blake. We want to say
Yeah.
it's money and we want to say it's an investment. It can't be both.
No. And I would totally agree with that. It can't be both. And I'm on the side of it is a counter risk or a counter volatility trade and has been for a long time. And so my question for all the crypto people is, if you're all the way up here at the highs and you see the market doesn't trust equities, including the Mag 7, it doesn't trust gold, do you feel super confident in holding? Are you going to hodl this thing? Because if you're going to hodl it, you could hodl it all the way back to 65,000 in a matter of 2 weeks. And I'm not being hyperbolic there.
Absolutely. I mean, it's down 3% today. The S&P is down 0.75%. Gold's down 1%. So at least on today, if we take that as a microcosm, they were saying Bitcoin may still have 3 times more than gold, and gold could drop 10% plus,
Yeah.
right?
Yep.
Rick says, but Bitcoin has zero intrinsic value. So that's the point of money, right? So the point of money is there is no economic value except for as a medium of exchange store of value. Gold has no intrinsic value, right? It's not a good commodity. It's soft, it's heavy. So again, it's just a rare rock that we can't just mine a bunch of it.
Mm-hmm.
And so same with Bitcoin. So Bitcoin has much the same attributes of gold, is that economically gold's pretty useless, except for the fact that it has no value except as an exchange, medium of exchange and store of value. But same thing with Bitcoin. Bitcoin.
Yeah, and I would argue that one, because gold does have value in medical and electronics and things like that.
But
Bitcoin doesn't.
so little of it's actually
Yeah,
used,
and I'm
right?
saying
So
you could actually use it. It does actually have some utility at some level. Bitcoin has zero utility. It is just purely.
which makes it a perfect form of money, because in
Yeah,
theory, money has no value
yep,
except as and the store of value comes because it's rare,
yep.
right? So you're not looking for intrinsic value in terms of economic worth, in terms of you can use it for stuff, because gold is used for very, very little. Most all gold that's been mined is still in existence today. It doesn't get consumed in processes like silver and that. And so again, that's the exact point, is because if it did have value, if it did have value economically, absent money, then it would not be a good form of money.
Yeah, and they're talking about watching the growth rate and inflation data and watching for further cuts, but it really is going to come down to inflation. And that they also have the still upside risk, and their forward projected upside risk is 5. Where'd it go? I just saw it, but it's moving at my closed
Yeah.
captions jumping up while they're talking, and so I just lost my line.
So
Shoot.
Blake, are
Yeah.
wages outpacing inflation?
No.
No, right? So wages, and really have not. If we go back, 25 plus years, on the whole, wages have not outperformed inflation. That's why in reality we've gotten poorer. In fact, the S&P is not really outpaced inflation, or at least the price of gold. Gold is a negative return over time, right? And so if the S&P is not outperforming gold, it means there's no real returns in the S&P if you go back
Right.
to 1997 as well. So a lot
Well,
of
and then
issues is that
yeah,
inflation does not create wealth.
and gold's cost of carry is roughly the interest rate, average interest rate for that entire time. So you're actually looking at losing about 3 to 4% in cost of carry on gold. So when we talk about that S&P hasn't gone up, even if it was flat, you've lost 3% a year when you adjust for inflation.
Yeah. So again, you take a ratio of the S&P to gold, you could go back to say the current level of the S&P is virtually 1997 levels. Means we've not actually, the purchasing power of your S&P shares have not actually gone up, and in real terms, it's actually generated a negative yield.
See if I can get this chart to pull up for us. I don't think gold goes back that far. Oh, it does. Woo!
Yeah, gold futures do.
Yeah, gold futures do. I wasn't sure if it would report it. And this is one of the things when we talk about, we as analysts talk about the lost decade, is really even further than that. When we look at the correction in 2008, do you understand, everybody, this S&P compared to gold. So you had your dot-com boom, you had your recession through here, you had your boom through here. S&P climbs up end of 96 as we finish out the recession of 96. We climb all the way up to the dot-com boom peak. And from 2000 all the way to 2017, there was no net growth when it comes to inflation. So then all this move through here, that's not good news, my friends. And this is not the perfect chart for what we're talking about, but
So
that
pairs ratio will give you the
pairs
exact,
ratio
but
gives you the exact,
either
but
way,
I
yeah.
just threw
But
that in there.
you got it. Yeah.
Yeah, so it gives you the same kind of concept, and that's the idea that really there wasn't any growth. You were just trying to keep up with inflation. So this move here is a duplicate of that, and we could be facing another lost decade if what we're seeing from the Fed and their statements today is true, that we're struggling with employment. Let's see what happened in 2000. Struggling with employment, what happened in 2008? Struggling with employment with inflation still climbing, that creates the stagflation, the pullbacks like we saw in the late 70s, early 80s. Now that's where this resets all the way back here, where it dropped from 23 all the way down to negative 755. A major calamity there when you adjust for that stagflation. That is super stagflation right through there. And what do? We dropped back to the same level despite all the growth in 2000 when you adjust for inflation. Could we see that same decline? Yes. Could we drop back down for the relative value of 60%? Yes, because that's what the chart says. We can argue it, but the chart says it's possible.
Absolutely.
All right, let me come back here and just grab.
So on the point of inflation, has inflation moderated a little bit and wages have remained relatively elevated? Yes. But again, you look at a lot, depending on what gauge you're looking at. I mean, it's not really, wages are not really outpacing inflation. And also wages are not distributed evenly, right? What's the median wage rate, is that kind of thing. So there's lots of variables there, but in general, though, wages have not really kept up. Wealth has diminished, generally speaking.
Well, and one of the things to keep in mind with inflation, because Jerome Powell can tell us that inflation's in check at 2.8%. He's restating that for the umpteenth time right now. Yeah. He keeps wanting to say 2.8, 2.8. As we're looking at this, you got to remember that in 2020 and after, we went up 10%. So if we had a $100 mark, says what does $100 buy? It went up 10%. Then it went up 6%. And then it went up 2%.
Yeah.
So when we're looking at this, we're net up 20% higher than what we were. But we're adding the 6% and the 2% are 6% of the 110.
Right.
The 2% is 2% more on top of the 118.
Right.
And so this 2.8%, we are so far away from that 2020 move that the inflation and the wages have increased. What did we increase? 0.6%. I think that was what the wage increase showed.
Yeah, I think in the last year, wages are 4.6%. But here's the thing is that we're talking about what Blake's describing as compounding. Wages have not compounded at the same rate that inflation has. So we're really just walking away from in terms of purchasing power of our wages. So it's a negative. So lots of ways to look at it, but that's.
Yeah. So how do you invest for this? Alvin asked a great question. I think that's always my question. So that's it. That's the question. So now what? What are you looking at now? Now that the Fed's after, we're going to get past the ball to Corey here in about 8 minutes, but now we're after this. Where do you think your trades are going to lie? You've already got your VIX trade, and maybe more of those to come. If we keep seeing the volatility set up, you could continue to buy out of the money VIX calls, because I think 20 is not only the top of that. I think we could go 25 and 30.
Yeah. So I mean, look, we could really push. The cost is gonna be a little higher now.
Uh-huh.
But yeah, I mean, this is where too often we describe the temperature of the water. We're saying, oh, we're in a bullish trend. Yeah, but that's not very forward looking, right? We're always wrong at turning points. So that's not enough to really do your due diligence. And so hopefully over the last couple of weeks, you're taking profits. You've maybe hedged a bit. Maybe you've taken some bearish trades. Maybe you've taken some bullish trades too. But now we're seeing the selling. Sometimes it's hard to jump on board with the selling right now, but there's probably more downside. There's probably areas that have held up relatively well. But this is where, from my standpoint, man, I'm really waiting for the bottom. And for me, that's going to start to occur when the VIX moves high above the 3-month VIX. And at that point, I'm saying, hey, we may be looking for a decrease in volatility. But I've been expecting a 5 to 10% correction here for the last couple of weeks, because that's what the volatility markets have been saying is likely or possible. But again, could you still buy protection? Yeah, you could still buy a S&P put spread, right? Those are still priced well with the high skew. If you want to just lay something out there, you don't want to pick an individual stock. And you could say, real estate breaking support today. Man, if we see a big sell-off here, real estate could really get hammered given this scenario. But you're shorting into the hole. So how do you short in the hole? You buy an out of the money spread or something, right? I mean, Blake, you might advocate even selling something. But right
If the
now,
volatility
again,
is high enough, sure. But
sure,
right now, you're
the
winning on
volatility's
the
not
out of
high
the
enough
money
yet, though.
buy. Yeah.
Yeah.
Yeah. I
So
mean, I took
so
a trade on the
vertical spread is the
SPX
way
for
to
that
get
same thing.
short on stuff you want to get short on with limited risk.
Yeah. I mean, I took a short out of the money SPX vertical before the announcement, out of the money, because I knew my risk, kind of like your VIX trade. It's not
Yeah.
there yet, but I know that there's a better chance that we unwind some than we keep pricing in more. And so I bet against this, and I mean, it's $820. It's not nothing that's gonna. I'm not gonna go live on a beach in Tahiti off of it. But you're watching the volatility instead of buying the dip, buying the BTFD, buying the Fed dip. And as we're looking at the Fed dip, instead of buying here, wait for the bounce and then fade into the bounce.
Yeah.
That's if this is a big enough pivot, which I believe it is. I mean, I've been hammering on this for how many days that there's no volume. We're up at the highs. We're at the 100% or 0% for the year, and we're struggling. I have not. We day after day, I've said this is it. This is the top. If we don't see volume break out, and our money flow index and the market and everything today, we're getting reward. So I'd say a small bounce and then fade that with out of the money spreads until volatility is high enough that you can sell out of the money call spreads.
Yeah.
Buy out of the money put spreads until you can sell out of the money call spreads.
And
And
this
Hojo
is
or Hobo Joe, I agree. It's trader's market for sure.
yeah, and this is the point, is that if you're always waiting for the breakout, okay, I mean, if you're always waiting for the breakout and then you make a response, it's hard, right? I mean, it works for a little while, but then all of a sudden you wait for the breakout to the downside, and that's the scenario laid out. Nasdaq's down 13%, S&P's down 8, and you're down 46, right? So the problem is that we want to try to get to the point where you're thinking ahead by using tools that help you understand, hey, I got to pare back here a little bit, got to dial it back, and then you got to know when you got to dial it up. And so that's why I look at volatility measures, because this is how institutions are hedging themselves. This is what represents their expectations for volatility. Again, Dom's looking at the 60-point move expected for the rest of the week, and we're saying, look, I mean, this is expected to be a volatile event. So you can say, well, no, it's not, because the market's going to go up. We're in a bullish trend, but that doesn't always work, because the downside can hit you so fast and so significantly that you lose all of your gains. Someone mentioned Monday about PLTR, and they said, well, you said it was going to, it was around 65 at the time. You said, well, it's not going to go to 80. I said, well, that's not what I said. I said it could go to 80 or go to 30. the risk wasn't worth the reward. And you say, yeah, but it went up 33% to 80. Did you sell at 80? No. Okay. So
Right.
it could be down 30% tomorrow. So the issue is that we just got to plan and prepare, understand when risk is elevated, and we just got to take profits into that strength and then prepare for, corrections, and then prepare for the bottom. Right. And that's the exciting part of it sometimes, because the bigger moves are to the upside.
Yeah. Well, and that when the market's in correction, you got to remember that I always say it can go twice as fast, meaning both twice the percentage and half the time. So we kind of double on the way opposite from whatever the trend was. And I think this fits into some of the things you've talked about. The question is Adobe a good buy yet? It could be. I'd let it stop falling yet. I don't think we've stopped falling on this knife drop. But I think, Brandon, you've nailed it with some of your pre-market pulse stuff that you've been building out and prepping for. That's the idea. You plan ahead. I commented today that I'm willing to be wrong 60, 70% of the time because I'm trading for much bigger moves when they happen. So I'm going to take lots of small losses, and then when I'm right huge. And Brandon does a great job about doing this pre-market pulse. And this, I would say, it's not just a pre-market on a day, it's pre-market next year. It's planning where that pressure is building and pre-planning for the next move.
Yeah. And it's just based on how institutions are hedging themselves and their volatility expectations, because they're the ones that are trading it. Right. And so again, is it 100% no? Is it close to 75? Probably. So anyway, we'll see. So what can happen? Go looking forward the rest of the week. We can see some fake outs, right? We may see some walkbacks. Some people might take some of Powell said, we'll try to walk it back the next couple of days or early next week. So again, the initial reaction today is on the downside. Session's not over. It's going to be exciting for Corey. We're down 1.25% right now, but just realize we could see some volatility going into the week, and that may mean we pop back up again, which goes to Blake's point, gives you an opportunity to reset and reload to the downside.
Yep. Well, and he's even in the palace talking about the fact that these large stocks that the economy got in 2021, 2022, that the story is just we're unwinding from these large stocks. It said large shocks. Never mind. I thought he said large stocks.
Yeah.
Like, wow, he's talking against the, never mind, large shocks. I read it wrong. It's like, holy cow, he's talking about against the Mag 7. No, just kidding. I read it wrong. Sorry.
It's okay.
I was all excited.
We forgive
like,
you.
wow, that's going to be downside. Anyway. All right. Well, Brandon, we are down to the end of our time. We're going to pass the ball to Corey. You and I will be back in the main room and tomorrow, and on Friday morning, we'll be back live in this session. We can talk more about this. We might get the perfect little pullback to do some pre-planning like Brandon likes to do, and the bump and fade back into the downtrend, because this might have been it. Today could have been the deal. If we're doing this on a rate cut, which should have been a stimuli, this is a good sign that we may be facing more pullbacks. So be ready, be safe. Thanks for being here, Brandon.
Have a
Thanks
great,
everybody
folks.
else too.
Thanks, Blake.
Take care.